Welcome to Money 911, where we trade fear for clarity and confusion for peace of mind. Today, we're joined by a rare light in a noisy industry, Wallis Tsai, finance insider turned truth teller who uses math, ethics, and love for clients to build protection that actually protects. If you've ever wondered whether your policy serves your family or the sales machine, take a deep breath. This conversation is about stewardship over sales, freedom over fear, and building a legacy that's above board, built to last. Let's turn insurance from headache into holy ground. A promise kept, a family protected, a future secure. Please welcome Wallis Tsai. All right. Wallis, it's really an honor and pleasure to have you here and talk about some great conversation, jumping right in, right?
Yeah,
Thank you.
thanks so much for having me.
And, I wanted to just go right into if insurance had to wear a warning label,
hmm
what would yours say and why?
So I feel like I need to try and keep it pithy. So maybe I would say something like, warning, one size does not fit all.
Boom. That's good.
And
That's
I
good.
can go into the reasons for that if that's helpful.
Sure, sure. Go ahead.
Yeah. So the reason I say that is because for a lot of insurance decisions, and this is true whether it's life or disability or long-term care, it comes down to an understanding of what an individual could qualify for. Because insurance is different from most products, where for a lot of products, as the consumer, you look around, you decide what you like, and then if you're willing to buy it, you own it, right? It's like pretty straightforward. Whereas with insurance, there's this element of applying, and then somebody else, the insurance company, decides if they're willing to sell the product to you at all, and if so, at what price level. And then on the other side of that, for not all insurance decisions, but for some insurance decisions, there's a meaningful element of thinking about the tax situation of a customer and also their other things that they might do with money if it weren't insurance. And so you want to make sure that you're keeping an eye on that comparison too. And that can be really different from one person to another.
Absolutely. I've never seen a one size fits all for sure. Explain like good insurance, say to a teenager with a backpack, like
Mhm.
what goes in, what stays safe, what grows, because the opportunity with all those years of longevity, right, that they can really grow the money. What would
Mhm.
you say to them?
Okay. And sorry, is this for a teenager, like somebody who's actually in their teen years?
Yeah, the end of the teens where they could literally start saving money instead of waiting till they're retired.
Yeah, yeah, got it. Yeah, so I mean, this can vary a lot based on the person's financial situation, right? Are we talking about a teenager who is themselves earning a ton of money, like say, Serena Williams was back in the day, right? Or are we
Right.
talking about kind of a more regular type of teenager? And
Well, teenagers that could put away 50 or $100, say, they could start saving.
yeah, so I would say generally for that profile, assuming this is kind of a typical teenager, and my son is 12, so he's almost there himself, but I would generally say that in that scenario, the odds are stacked against insurance being the right tool for the job. And that if you're looking for a savings vehicle in that situation, then if the teenager has some earned income, maybe you go with a Roth IRA. There are different options available based on phase of life and financial situation. And so I think it would be like a uniquely positioned teenager who needs insurance themselves. Although we do certainly help some clients with setting up a nest egg for their children. And that's often more of a strategy that you might do with a trust. But that tends to be like a more kind of affluent family solution and not like 50 to $100 a month. Yeah.
So what would be a 5-minute smell test, say anyone can use to
Mhm.
spot, a
Mhm.
too good to be true illustration?
Hmm. Yeah. So is this for life insurance specifically or just,
Yeah.
okay. Yeah. So assuming that it's a permanent life insurance policy, meaning it's not term and it's not something that you're buying just to replace future paychecks or the cost for your loved ones to hire somebody who would provide care to, if you're somebody who provides care for free, like a stay-at-home parent. So assuming we're looking at permanent insurance, you really want to be careful because those products can work out great when they're used correctly, but it takes a lot of specific analysis to decide, like, is this really the best use of your money? And so I would always ask yourself the question, if I weren't buying this insurance policy, what would I do with the money? And then ask the person that you're working with if they can lay out for you clear reasoning with numbers about why the insurance policy really serves you well. And if that cannot be demonstrated to you, then I think that is certainly a red flag that you want to dig into some more.
Good. So a peace of mind, the ROI for peace of mind. How do we measure safety with the same pride we measure returns? The balance, I know it changes with age, but how
Mhm.
would you position that?
Yeah, so this question around peace of mind and safety, right? That has a really valuable role to play. And there are different ways to achieve that goal, right? Like one of the things that's unique about life insurance that's different from pretty much any other investment, out in the universe is, or any use of your money in the universe, is that life insurance can give you just extraordinary returns in the event of tragic events, right? Like if we're talking about term insurance, which is designed to be temporary, that product is priced so that if you can actually qualify for it, it's because the insurance company thinks you're very out likely to live it. And so at first, sometimes people have the reaction of like, well, hey, isn't that like a waste of my money? And the answer is like, no, absolutely not. Because for people who should buy term insurance, it's because somebody, or maybe many somebodies in their life, depend on their future paychecks or depend on the care that that person provides for free to them. And so if you think about, a working mom of two young children, if God forbid something happened to her before she retired, all those future paychecks would not exist for her children. And so what do her children do? And even if that young mom is married, and let's imagine that her husband has a good job, oftentimes for two income households, the lifestyle of the family still rests on both incomes. And then the other piece of the analysis you want to think about is, well, could he generate the same level of earnings as a single dad? Right? Because not every job and level of earnings is compatible with suddenly being a single parent. You might have to take a step back at least for a few years while you stabilize the situation. So I do think when you mention, peace of mind and how you think about that, there are some things where it's just like you cannot afford not to do this, right? Like you are setting your loved ones up for a horrible situation if God forbid something happens to you. And so you want to make sure that that risk is taken off the table first. And then beyond that, with like insurance that's not temporary, that's permanent. So whether we're talking about whole life or indexed universal life or variable life, that's where it makes more sense to get into this question of like, okay, I'm buying insurance. There's this element of peace of mind, but I'm also putting money into something where if I live a normal lifespan, I'm still planning for my loved ones to get something back. So I want to see how that math works too.
Right, right. Well, you did your time on Wall Street. So it's what did you what did it teach you, right? When you laid what you learned on the altar of real life and made your shift into what you're talking about now.
Yes, I think the over 10 years that I spent at Goldman Sachs on Wall Street, first as an investment banker and then as a hedge fund investor, one gave me a undying love for Excel spreadsheets, right? Like that's just part of me now. And so,
Right.
but I think, importantly, right? Like, well, why do I love Excel spreadsheets? It's not because I just think they're fun. It's because I love doing analysis that reveals the right answer, right? Because so often decisions in life, certainly in finances, but even more broadly, this is probably true. Decisions can feel confusing, right? Or we like worry that we're doing it wrong, or like we think we know why we're making the decision, but we're not totally sure that we're sure. And what I like about the spreadsheet is that that is a place, and it's especially true for insurance, where it really reveals the truth to you if you do the math correctly and you're honest about what it tells you.
That's
And I think that that clarity of insight leads to good advice.
right.
And it's the reason why sometimes when clients work with us, we end up telling them, like, hey, based on the analysis of your situation, I don't think insurance is the right tool for the job.
Right.
And that's a minority of the time, right? Because insurance used properly is very useful for a number of goals. But sometimes it's not the best tool for the job. And if you have an honest, accurate process, you'll know when it's a great option and when it's not.
I've created the Safe Money Blueprint. This is the same strategy that thousands of my clients have used to feel secure about their financial future. And you can get it free at healthymoneyhappylife.com/blueprint. So explain a great policy, like a letter to your future self on a hard day. What would it say?
Mm-hmm. Yeah, so I would say a great policy the policy that like writes a letter to you for yourself might say something along the lines of like, you know, I am so glad that I was able to produce for you the benefits that you were hoping to achieve back when you bought me decades ago. And I'm phrasing it that way because I think a lot of the mistakes people make about insurance come down to people either not using the right tool for the job or not really understanding what they own. But with good, and that often happens because people didn't get clear, accurate advice. But when you have clear, accurate advice and you know what you're signing up for, you can go into it with expectations that are aligned with what you're getting. And then that's where you can get those really good outcomes.
Right. So if you had it like a time machine that went back to the moment the listener bought the wrong policy, what two questions would save them?
That's a good question. So I'm thinking about situations where I'm shopping and I don't exactly know what I'm looking at. And so, like, what questions can you ask? Because, yeah, I know insurance and financial products really well, but I recognize for a lot of people they don't, right? That's normal. And then for me, that sense of, wanting to get it right, but not feeling confident if I can comes up in places like, like the hardware store, for example, where I just really don't know what I'm doing, but I also don't want to mess up my house, right? So one of the questions I sometimes ask, and I think this is a good question for insurance too, is can you describe to me the situations 30 to 50 years from now where I would be really happy I had bought this policy? And then can you describe to me the situation 30 to 50 years from now where I would feel disappointed?
Good.
And I
Good.
think
Yeah.
that if a professional can't answer that, if their answer is something like, oh, this thing is like awesome in all scenarios, there's nothing better. Yeah, I would consider that to be like a light on substance answer and concerning, right? So, yeah,
Right.
yeah, because
Mhm. Yeah.
yeah,
Not
I
enough
think it,
information.
yeah,
Right.
and I think yes for two questions, right? So there's the one where it's like, where would I be happy I'd own this? Where would I not be happy I'd own this? And then I think, yeah, similar to when you're navigating maybe like a personal medical decision, a good question for insurance too is, well, what is one alternative that's reasonable to consider?
Okay.
And the reason I think that's an interesting thing to ask is, and why, right? Is that if you're talking with a, licensed agent and like I am, and like we have it above board, right? These are people who look at a lot of different insurance policies, know a lot of different insurance policies. And even if like I feel strongly for a client that there's a particular policy that just is absolutely an amazing fit for what I understand their goals and situation to be, there's always something else where it's like, you know what, if you actually, you know, changed your mind and felt this way about that thing we talked about last week instead of that way that you'd mentioned, like this other policy might be a better fit. right? So sometimes I can give you an example of that if that's helpful.
Sure.
Yeah. So sometimes people who are financially in a situation where they're interested in taking on permanent insurance, right? Something that's not temporary, it's not term. They think, oh, well, I should look at whole life.
Mhm.
And whole life has a lot of nice guarantees that provide protection from downside, but the upside looks more like what you might expect from high quality bonds or fixed income investments, right? So if you go into whole life thinking, oh, I expect this to match the S&P 500, you will be disappointed,
Yep.
right? Like, because that's not how that type of policy works, right? That the whole life is a great product, right? Like I really like it in a lot of ways. Not for everybody, importantly, but like if you're looking for something that kind of works like a portfolio of bonds, but with some interesting guarantees that actually make it less volatile, it can be a really great choice. But so if somebody says like, oh, I want something that's stable and reliable and I'm not going to lose money, and it'll last my whole life, and they're also in a situation where they're ready to, you know, do the premiums, and it's not an affordability issue, whole life might be great, right? But if they ask that question, what's one thing that I could consider that would be like maybe a reasonable alternative? I would say that, let's say that imagine that person told me like, I care about getting this permanent insurance coverage because I really want to leave a legacy for my grandchildren. That's my top priority. I might mention to them that, variable insurance is something that people consider if they're looking for the chance of higher upside through the performance of investments like the S&P 500, that they're also willing to tolerate the volatility that can come with that. And so, like, if you were interested in something with more opportunity for upside, but also more opportunity for volatility or the possibility of loss, that could be a reasonable thing to look at, right? Plenty of people planning for their grandchildren do look at variable policies. But, for the person who really values downside protection, variable's probably not it, right? But
Right.
I think when you start asking questions about alternatives, your professional should be able to explain the differences.
Exactly. Exactly. And, there's a lot of conversation, a lot of people, and they've been doing it for decades, but using the whole life instrument, infinite banking, bank on your, they have different phases, but a lot of real estate people use those kind of policies to flip or buy houses or real estate. How would you explain that to someone that's just kind of, what is that? How does it work?
Yeah.
Uh, right.
Yeah, yeah. So are you thinking about a structure where, say, like, maybe it's trust owned and like the policy lives inside the trust, or
No, I'm just thinking about the average person that's just trying to, an entrepreneur, and they're trying to take some of their money and get it from a bank that they're paying taxes on money they're losing to put it into something that they're, they have the security, the death benefit's going to remain, but then they can, take loans and pay the loan back and how all that works, right? With a
yeah,
whole life. The way the real estate people are using it now.
yeah, sure thing. So with a whole life policy, the interesting thing about the structure of that policy is that the guarantees are really strong. And there's basically a guaranteed baseline of growth that assumes that dividends are zero, right? That the extra amount of money that could get paid out each year just stays at zero forever. And even then, the insurance carrier, and I'm speaking in generalities here, but this is how the
Mhm.
products work for like the largest, kind of most established whole life carriers. So you have this baseline of growth that's guaranteed, and it's backed by the full faith and credit of the insurance company that you choose, right? So right off the bat, there's just an extraordinary level of protection from downside volatility. And then I mentioned dividends earlier, and dividends with whole life work kind of similar to like if your listeners have ever owned like a stock or an index fund or a mutual fund where they get paid dividends, right? It's the same kind of idea with whole life, but in this case, it's the insurance company saying, oh, look, we have some money left over at the end of the year. Let us pay something extra to our whole life policyholders. And now, importantly, those dividends are not guaranteed, but for all the big, well-established whole life carriers, they've been making those payments without missing a year for like over 150 years, through the 2008 financial crisis, through the Great Depression, through World War II, haven't missed a year, right? So these are not guaranteed, but also have a very strong track record historically. And so the way that the whole life policy works is that over time, you get that baseline growth that you're guaranteed. And then you have the dividends on top of that. And so if dividends continue to get paid going forward, what the illustration shows is that you have growth in both your cash value and your death benefit over time. And those policies can be helpful sometimes in sort of being paired alongside other assets where it's real estate or whether it's real estate or something else, because you can quickly access large amounts of liquidity without having a tax event, right? So like if you think about like, what do I need to go make a real estate purchase? Oftentimes, even if you're getting mortgage financing from somewhere else, you still have to come up with a meaningful amount of cash yourself for the down payment. Or maybe you want to finance the property without mortgage financing, or maybe you need to, right? Maybe it's a competitive buying situation and you just need to like close in cash and then figure out your optimal financing structure later. And so having that stable, not volatile asset that is the cash value of a whole life policy can sometimes pair really nicely with investing in these other asset classes, whether it's real estate or something else.
Right.
Is that responsive to your question?
Yeah, that's good.
Cool.
So if legacy had a heartbeat, how should each coverage change in each life chapter? Because I see, when you're 20 and 30, it's hard to imagine what it's like at 40 and 50, and let alone 60 and 80. Each age has its own set of important things that people need to know about.
Yeah, 100%. I think the point you make about life changing and people not necessarily knowing how it changes precisely is really important, because I think so much of what we do is trying to help people connect with their future selves, right? Knowing that like neither we nor they can predict perfectly what's going to happen, right? Like, for example, out of all the young parents I talk to, I don't know who's going to live to see their child graduate from college and who's not, right? But we know statistically, like not everybody lives to see their child graduate college.
Yeah.
Right? And so I think that to your question about insurance by life phase, on average, what you need follows who's depending on you. And so in the beginning, when you get that first job, you might already have a spouse or kids, but oftentimes it's just kind of you, right? Getting your first place, spending time with friends, but you're still your own dependent, right? Like unless you're from a family that's so wealthy that any job you do is truly just for fun, which is not most people's situation, then you need that disability coverage. And that disability coverage needs to grow with your income over time. Then as soon as anyone else in your life depends on your future paychecks or the care you provide for free, that suggests that it's time for life insurance. And as you move towards kind of mid-career or towards retirement, you are thinking about, even more than before, right? Not retirement savings, and maybe even looking for things above and beyond what you have access to that's tax advantaged or matched through work. And that's where sometimes permanent insurance can play a really interesting role. And then also thinking about long-term care as you approach that age where, those of us, who are lucky to see age 65, right? More than half of us end up needing some amount of long-term care, right? And so how do you think about the options that you'd want your future self to have if either you or if there's a spouse in the picture, that individual had a really big long-term care need, right? Because oftentimes these decisions for couples are not just about what happens to one person, but about what happens to each of them, right? Like I watched my grandmother and grandfather, taking care of each other, having their own needs. Like it can get very complicated, right?
Yeah.
And so thinking about how to lay the groundwork so that if you don't live the dream of like being healthy and independent until you're like 110 and then passing away peacefully in your sleep, which, we all hope for, but most of us don't get that. Right? Like
dream on.
Everyone has that first choice, but we know it's not most people's reality.
Right. Exactly. And I mean, and age has something to do with it. When you watch family members go through it, I think I'm pretty passionate about the long-term care. Yeah. And I saw that changed over age. When I was in the business younger, it wasn't a big part of my conversation. And then when I started seeing family members going through it, and nope, we all live in this, it'll never happen to me, right? Everybody else dies or gets sick.
Mhm.
And that was pretty much in my family's story. And they went through millions of dollars because they didn't have catastrophic protection. It definitely became the fuel of why I'm, still broadcasting and sharing because it's so important.
Yeah, no, you're so right. And I think unfortunately, sometimes people don't really take action until they're confronted with something
I
personal.
know that's the thing,
It's
right?
really hard. Yeah.
And I've been in practice 35 years and I've had thousands of people come to my office and when are they starting their retirement plan? 50, 60, 70. And
Mhm.
it's not, there's no judgment. It's
Mhm.
just they haven't been taught, right? And so that's what's so inspiring to me about these conversations. So I wanted to ask you a question.
Mhm.
One question for someone that's wants to know, as my advisor, what would be the one question for them to vet out their advisor to really know that they're in alignment with what their goals and outcomes are?
Yeah, so I think it's always good to ask your advisor, just like explain to me how you're compensated and what entities you're affiliated with. Like, how do you work?
Okay.
Right. And it can
Yeah.
feel a little blunt to say that. Like, I think some people have no problem asking that, whereas other people feel very uncomfortable. And I would really encourage people to just ask
Yeah.
it. Because the reality is that like all advisors have some sort of incentive structure, right? Even for folks who say that they're fee only or fiduciary, right? Like we all have some sort of incentive structure.
Absolutely.
And I think being transparent and clear is really important. And it's not so much about like, oh, this whole category of people is good and this whole category of people is bad. It's like you really want to, I think, work with somebody who is comfortable explaining to you how they operate and what that means.
Right. Okay, I got one for you. Finish
Yeah.
this sentence. Insurance is not a product, it's a promise to blank, and here's how we keep it.
Okay. It's a promise to support your future self and loved ones in the moments that you and they need it most. And we keep it with, in the case of good policies, which many of them are, um, well-structured policies and maintaining our financial strength through the years. Yeah, like you look at a lot of the successful insurance companies and it's pretty amazing how well they've done for how long.
Yeah, right.
Yeah.
Exactly. Well, let's tell everybody how they can get in contact with you.
Yeah, so we actually put together a page for listeners on the show. So folks are invited to come visit us at www.aboveboardfinancial.com/money911. That's aboveboardfinancial.com/money911. And on that page, you'll find a few different options for how you can get in touch or just learn about the different things that we offer. And would love to, connect with any listeners.
All right. Well, I really appreciate your sweetheart and tenderness with numbers, the way that you do all that you do, and I'm really glad that you got to join us today. Thank you so much.
Thanks so much for having me, Kris. I really enjoyed our conversation.
Wallis, thank you for bringing truth with tenderness and numbers with heart. Friends, your legacy is too sacred to outsource to marketing. Choose math over hype, stewardship over sales, and design protection that loves your family when they need it the most. If today sparked courage, pull your last statement, ask the brave questions, and make wise moves. Because peace of mind isn't a fantasy, it's a strategy. Until next time, breathe, believe, and keep building life and a legacy you're proud to live right now. There's so much to learn about healthy money. I hope today's discussion brings you one step closer to securing and protecting your future. So you can get started on the right foot, go to with krismiller.com and schedule your free financial fitness strategy session. Thank you for listening, and please subscribe to Money 911 so you don't miss our next episode, which includes health, wealth, and peace of mind.